All right, good afternoon or evening or maybe morning, depending on where you are. Day four, short vertical spreads coming your way. My name is Ray Kimbrell. I'm joined by the one and only the Scott Durfee. I'll intro him here in just a minute. But it's great to have you all here. We've been having three great days ahead of us, and now we got our last instruction before we get into our Q&A tomorrow. And we're gonna, like as someone has said, we're gonna finish this on a high note. I do believe. I think Scott summed it up better. It's best yesterday. What he said is it's almost going to be. Would you say it was illegal to have this much
Hey,
fun?
we're going to have more fun than it should be illegal to have.
There you go, man. So we're gonna do the same today. So a few admin things. Again, there's literally thousands of you all
Yeah.
on the call, and Scott Thompson is a machine back there helping out on the chats. And Scott and I will try to get some questions in from the chats as we move along if we can. But just remember, it's going fast and furious, so we'll do the best we can to work that in. But thanks, Scott Thompson, for everything you're doing this whole week on the chat. It's been phenomenal. And then let's go over probably some of the more crucial things we have to talk about, and that's this disclosures. All right. So, this is about really real trading. So just know that options do carry a high risk and are not suitable for all investors. Long option investors, you can lose up to 100% of your funds invested. Spread trading. All right, spread trading, we're doing this today, must be done in a margin account. All right, multiple leg option strategies involve multiple transactions costs. Got to remember that when you go through. All right. Also, Scott and myself, we're going to talk about live examples. We're going to look at actual stock charts. Please do know that that's not a recommendation. It's not an endorsement. We're not offering advice, but we have to show you an example, right? So we're going to look at real stocks out there, real symbols, and it's just know that that's exactly what it is. It's for education only, and please do not look at it any other way. Okay. Um, and also, you have a paper money account. That paper money account is a great way to practice some of these new strategies, if they're new to you, or even if they're not new to you. It's a great way to practice without the fear of losing money because it's not real money. All right. And just know that the paper money account, although it looks similar to a live account, they are different. There are some subtle differences in fills, for example, and there's some other things that aren't included in the paper money account that you get for the live account. All right. So there you go. You can read the rest of them up there on the page and understand this is real stuff. And we thank you for understanding. Okay. So that brings me to this real guy. All right. Scott Durfee's been doing this for a minute. You can see he's one of the red contributors to the Schwab Network, which is brought to us by our separate but affiliated company, Charles Schwab Media Production Company. And he does a great job on that. And you can see that he specializes in teaching thinkorswim platform, technical analysis, stock and option strategies, and many, many other things out there. But more than that, he's a great family man and a great friend. And nothing better than coming to work with one of your best friends out there. So there you go, folks. You could be jealous if you want. All right. With that, Scott Durfee, what say you, my friend?
Hey, I say thanks, Ray. You always make me a little bit uncomfortable when you say stuff like that, but that's pretty much true. Gang, it's my pleasure. And tonight Ray's gonna start the instruction tonight, so we're gonna go straight to Ray. I'll be coming in and helping through the dialogue and through the conversation as the night goes on. But it's always my pleasure also to introduce my good friend, Mr. Ray Kimbell. Ray and I have been doing this together. He started a couple of years prior to me. He started in 2004, but since 2006, we've been pretty much lockstep. We've worked together doing many of the same things, but just right along side by side, teaching and contributing on the Schwab Network, again, a separate but affiliated company. Specializes in teaching the Thinkorswim platform, technical analysis, and option strategies. It sounds like you just heard that. Again, we've been doing this pretty much lockstep since 2006. Ladies and gentlemen, nobody better qualified to take us through our instruction this evening than my good friend, Mr. Ray Kimbrell. Take it away, buddy.
Thank you, my friend. Thank you very much. All right, folks, here we go. So here's what we did. All right, we're at the short verticals right now. Tomorrow's the Q&A session. And but before we get in to the meat of the matter, Scott and I talked about this, and we're going to do something a little different. What we're going to do is we're going to go here to the platform. And already had a question. Yes, this is the Thinkorswim desktop platform. Okay. And then what we're going to do real quick is we're going to show you and review a little bit of what happened yesterday. All right. So yesterday we talked about short puts, right? Now, short put, again, is a credit type trade where you're going to pull in premium. All right. When you place this trade, if you get filled, when you sell the put. And one of the big things when you sell a put is you're obligated. All right. And the obligation that you incur is that you could possibly be required to buy the shares at that strike price on or before that expiration date, in a nutshell. And Scott, when can that happen?
That can happen anytime.
There you go, folks. Remember that anytime. All right. No rhyme or reason, can happen anytime. You just got to remember the market maker on the other side of the trade is the person who's responsible for those type of things, because they have to fill orders. That's their job. And if it is, it is what it is. Good news is, majority of the time when you're making these trades and assuming you're using looking at the volume, open interest, those kind of things as well, and we'll get into that in a minute. But there you have it. So this is one of the examples. All right, we did AMD, talked about AMD yesterday. All right, now if you're going to sell a put, Scott Durfee, what is our bias on
Our
selling put?
bias, if we're selling a put, our bias is overall bullish, can be somewhat neutral, but overall bullish.
Bullish. So an uptrending type stock would be something we might look for, correct?
That is correct.
All right. So in this case, we have our 10-day moving average is up, just kind of coming back a little bit here. Our 40-day moving average is moving up. Our MACD is starting to crank back up, and we have a high implied volatility. So Scott, high implied volatility. Why is that such a key thing?
Well, high implied volatility will be tied all directly. I mean, it's not the only thing, but it's one of the main things that influences the price of the option pricing, right, or the premium. And so, yeah, high volatility typically means higher priced options. Lower volatility typically means lower priced options. So when we're selling an option, higher volatility means that we can sell high. And again, we want to sell high and buy low, or buy low and sell high. That's also true here
There
with
you
these
go.
options, right?
There you go. All right, and folks, a good question. Someone just said I thought European style
Yeah.
stocks or options or aftermarket close. That's correct. You cannot get assigned early on European style, but these are not European style. These are American style options we're talking about in these stocks. So, good question and good comment. All right, here we go. So and by the way, the reason we're doing this really quick review is when we do a short put vertical, which we're going to start with. Half of a short put vertical is what? A short put. All right. So here's the cool thing. As you're learning this strategy, a short put vertical and a short call vertical, you got short calls and short puts as the driver of the trade, really. They're the driver of the trade. All right. We did short call verticals yesterday in a covered call scenario where you had to own the shares prior. But when you do short puts, short put vertical, short call vertical, you do not have to own the shares before you place the trade. Okay? You do not have to own the shares in the account at all. All right? So just remember that. So this is a good review to get you ready for your short put verticals, and it kind of reviews yesterday's class. All right, so we're feeling kind of bullish there. Yes, Scott, we're looking pretty good in that regard.
Yep.
All right. So if we wanted to do a short put vertical on this, we would go to the trade tab. All right. And then we're looking, again, we got some certain criteria. We look at potential 30 to 40 deltas. And we do that because remember, the delta, the Greek delta. All right. Not only does it show the sensitivity of the option to the stock move, all right, but it also is a proxy for the probability of the option expiring in the money at expiration. So if you got a delta of 30, that's a probability of the option expiring in the money of 30%, which means it's a 70% of it expiring out of the money. And as you saw yesterday, one of the reasons you might do a short put is to generate some cash flow. All right. Whereas you don't want to take possession of the shares. All right. But you got to ask yourself, am I okay with doing that? So if you have a 70% probability of that option expiring out of the money at expiration, that might make you feel pretty good. Okay. So that's why we look at that. And then we look at time frame. All right. 30 days out here. All right. We're not going out 99 days, 127 days. And there's a reason for that. It's called theta. Remember, one of the things you want to happen more quickly than not is you would like to see your put option losing value more quickly. Because what do you want to do? You're selling it high, as Scott just explained, and buying it back low. So the faster that it loses that value, the happier you are. Okay. Because remember, this is a bullish, neutral to bullish, but more bullish, all right, of a trade. And so if that's the case, put options, whether they're long or short, doesn't matter, but a put option will increase in value when the stock goes down. So if you sold the put, that is a good thing because you want the stock to go up. So if the stock's going up, the put option's losing value. And then if you have the theta decaying on top of that, that's even better. And if you have volatility, which is high, going down, taking away value, that's even better. So that's why we explain Greeks on the first day. So hopefully that comes in, all right? And we're looking at. All right. So we're not looking under calls, we're looking under the puts. Sorry, I should have put this over here. All right. So good question there. All right. So in this case, if we want to go over here, look at delta. Okay, looking at delta, and then we look down the column of delta, and here is let's say we do the 450, the 450 put. All right, we're going to sell the 450 put. So if we do this, all right, I got a 32 delta, which means about a 68% probability of being out of the money at expiration. Correct. So if we do this, we go right here. We're going to click on the word or on the price under the bid column, and you can see the word sell pops up. If I just click that, it's going to generate an order. Okay. And you can see here, it's got one contract, there's a negative in front because it's a put, or we're selling, I should say. 17 July 26, 450. All right, is the strike price. That's the premium we're pulling in. Okay. And this is done for the day. If I hit confirm and send, this is all review from yesterday. Y'all should be going, okay, got it. Yeah, making sense, making sense. All right. So if you go in here, we look at this. We're selling one AMD, all right, 450 put, all right, 25.25 to open. All right, break even. Remember, the break even price is what? The stock price minus the strike price. All right, so we can go through, it can actually go in the money a little bit, and you still have a break even area. Your max profit in this trade is $2,525. Not too bad. But you got to set aside $42,475. Now, it's a good discussion, Scott, yesterday when this came up. A lot of people are going, my goodness, we got to put all that money aside just to make $2,500? Answer is
Yeah.
yes. The answer is
But you're
yes.
going to buy the stock. I mean, you're planning to buy the stock anyway. That's why the caveat, don't
Mhm.
do this on a stock that you're not willing to own.
Yep.
So,
Now,
fuck.
some people may not want to own it, but they're willing to understand the difference there. And they're saying, okay, I'm okay with that difference. I know it's big. All right. And that's all right. But some people are going, you know what? If I can get paid $2,525 to buy the stock I want to buy anyway, and I get assigned, I'm okay with that too. All right. So just understand that. All right. So as you're ready to go, okay. Now then, if we have that ready to go and we understand that, now I want you to I want you to see something. Now we're gonna get into we're gonna change this real quick to a short put vertical before we teach it to you. But I wanted to show you something. Look at this max profit number, 25.25. All right. And then look at this max loss number. All right. 42,475. All right. Now watch this. I'm going to edit this. Okay. And I'm going to bring this down. Now that's the short side. All right. That's a short put, right? Well, a short put vertical is you're going to sell one strike price. All right. And then you're going to buy the same month a different strike price on that stock. Okay. So we sold this bid, we sold the 450 put, and now we're going to buy the 440 put. All right. Don't worry, I'm going to explain it. All right. I'm going to explain it, but I want to show it to you first, and then we're going to explain it, then we're going to go back again. Okay. So I'm going to hold the control key down on my keyboard, and I'm going to click on that 440 ask price buy. And what it did is it put together this trade. So now you see it says vertical. We're selling the 450, we're buying the 440, and now we're getting a credit of what? 370. All right? 370, not $25, right? So if I hit confirm and send, now instead of getting a max profit of 2,525, we're getting a max profit of $370, but look at this max loss. It's not 42,000. What is it? Oh, it's 630. Well, Scott Durfee, could that make somebody who maybe doesn't have as large of an account, all right? Could they now if you had a $50,000 account, all right, or maybe a little bit more, but you want to do this trade, all right, and you're now at a max loss of 630, maybe this is a trade you might be able to get into, yes?
Yeah, well, you know what, Ray? Yeah, of course, you got to have the right approval in your account to do these kinds of trades, number
Right.
one. But, however, take a look at that. You're risking $630 to make 370.
Yeah,
Yeah,
not too bad.
that's pretty good.
All right. So remember, folks, again, this is a short put vertical. All right. You're short one leg and long the other. All right. Now I know that was quick. I didn't expect you to stand at all. That was not the intent. The intent was to just show you what it is. Now we're going to go in. Okay. Now we're going to go in and we're going to go and say, okay, how did all this work? And we'll do this trade again at the end of all the slideshow as well as other ones. And I think it's going to help you go, oh, you're going to do this. You're going to go, I got it. I got it. You're going to hit yourself in the forehead. Okay. You're going to go, I got it. Okay. All right. Now then, no, I said the same month. All right. So someone said, did I look at this trade and say different months? No, this is the same exact month. Okay. Here we go. So I'm going to go ahead and delete this trade. All right. And now what I'm going to do is go back to the charts tab and keep it on AMD. And I'm going to go back to the slide deck. All right. And we're going to start. All right. You all ready? Take a deep breath. All right. Got a lot of questions in there, which I'm glad, because now we're gonna cover those questions. All right. Here we go. Objective. All right. And we do this, we're going to do short puts and short calls as we move along. You'll see some of the different ones. We'll talk about it. All right. But here we go. A short put spread. All right. To potentially profit from a sideways to trending and uptrending stock or an ETF. All right. By selling the put option at one strike to capture time decay, and also buying a put option at a lower strike to limit the risk. So this strategy, all right, has defined risk. And that's why you got to get approved, like Scott said, but you can do these inside of an IRA potentially. All right. But you got to get approval. All right. And the reason
Ray, you cannot. So
you cannot.
let's make sure that we make
Well, it's
that.
got to be a cash account, doesn't it?
You cannot do these inside of an IRA.
It's got to be a margin account, right?
Correct.
Yeah, got to be a margin account. All right, so good catch. But you still have to get approval, okay? Even if you go to a margin account, you still got to get approval, all right? And so here we go. So if you look at the slide, you got buy an option. This is the long put. So if you remember from day one, long doesn't necessarily mean time frame. It means you bought the option. You're long the option, just like you're long the stock if you buy stock, okay? Then you're also going to sell an option, all right, which is the short put, all right? Just like and again, not time frame, it's the terminology. When you short a put, means you sold to open, just as if you sold stock short, okay? So no, you cannot do it in a Roth either, okay? Just saw a question up there coming up. All right, and that's going to equal a short put vertical. It's exactly what we just did with AMD a few seconds ago. All right. Exactly what you did. All right. Now then, let's keep moving along. Money management. We kind of hit this briefly, but now let's get a little more in depth. All right. So let's say you have your portfolio and you're considering a portfolio risk of, let's say, 1 to 2%. So what does that mean? All right. Well, if you have $100,000, like we have in this on the screen up here, you have $100,000. All right. And you're going to multiply that by 1%. All right. That gives you $1,000 portfolio risk. All right. So basically what you could put into the trade. So this is right here. Consider the portfolio risk of 1 to 2%. All right. So that gives you kind of money. Now you don't have to follow this. All right, Scott, they don't have to follow this. They can do anything you want, right? It's their money.
Absolutely.
Right. But this is just a way to potentially go in and say, okay, um, here's a way I can look at my account and go, okay, will this fit well with me? So I'm not over trading or overexposing myself. So this is one way to doing that. Okay. So I just want to show you this to help you out. All right. So in this case, let's say your short strike, okay, is 177. This number is what, folks? The strike price, right? Where you're controlling the stock, like we just did with AMD at 450, right? All right. And then you had a long strike. In this case, 175. In our case, we did earlier was 450, 440. All right. And that equals the net credit. All right. The net credit you get, and that's your trade risk. All right. $1.23 per share. $1.23 per share. It makes sense here in a second, because here's what you're going to have. You're going to have a portfolio risk of 1,000. All right. And you have a trade risk of $123. Why is it 123? Well, because when you get your long strike and short strike difference, your net credit, all right, and that's what? $2 minus 77 cents, right? That's where the 123 came from. All right. When you divide that out, that's 813. The good news for you is we just showed you that point blank when you do the trade on that trade, your ticket, and you can read it and you can confirm what that amount is. All right. And then you can always edit it. So let's say you had too many shares or too many contracts you selected, and you go, oh, I can't do 5, but I can do 4. So you can edit the trade by going back and changing that amount as you go along. So this is a way to just gauge how much you're putting into any one of your trades really quick at a real quick visual. All right. Scott, any comments, any thoughts on that?
Yeah, no, just a reminder, the question just popped up. Can you be assigned when placing a short put vertical? And the answer is absolutely. It's still the same on that short put. So that is something that you do need to be aware of. It doesn't
We're going to
change
get
the risk, doesn't change the way you approach it, but yeah.
right. And we're going to get into that because here's the deal. I'm glad you asked that. We can say it. The more times we say it, the more it'll sink in. Because you got to remember, folks, before expiration, if your long leg is still in the money, it has value, right?
Yeah.
So if it has value, if you get assigned early, you still have the ability to go out and do what? Exercise your long so you can cap any loss you might have.
Yeah.
That's the idea. That's why this trade has defined risk.
I wanted to make sure we answered that real quick, Ray, because if we don't, then we get distracted from what you've got there in front of us. But
Yeah.
what Ray's talking about here in terms of money management, we teach this in every class. It's that important, but super easy. The way Ray just explained it to you, super easy to employ that in your account.
And the question here, where does the $2 come from? Remember, the $2 comes from this short strike minus the long strike. There's your $2, and you're subtracting the credit, all right, that you get there. That's where that $2. We're going to show this in more detail in just a second. Just hang tight. All right, here we go. And this is what I mean by defined risk. All right, so this is your risk profile, which you can get in the Analyze tab when you are on Thinkorswim. Okay, so max gain. Okay, so the max gain is the net credit. That's the difference between the two premiums. All right, the difference between the two premiums. All right, so in the max loss is your short strike minus your long strike. All right, and that's one number minus that net credit right here. Okay, and that's your max loss. All right. And break even point, short strike minus net credit. Let's do this real quick. Let's just show this real quick. All right. So if I go to the trade tab, all right. So 450. So 450 minus 440 is what, folks? $10, right? $10. Okay. And then if you see, if we get this 225 minus 220, okay, because you're what? You're bidding your ask price. All right. That's what's going to equal your YV come up, and you know what your risk is going to be. So that's why when I go in here and if I hold the control key down, click on sell, then hold the control key down, click on buy, we create the vertical. So we got a $10 wide spread. All right. And if you get that number and you get your amount here, subtract that amount, okay, from 10, that leaves you the 370 credit. Does that make sense? Okay. So when you go to confirm and send, that's how you know what your max loss is going to be. Okay. It's that quick and easy and simple. All right. You don't have to do all the math anymore. It's right there in front of you. Okay. So that's how I said, okay, if you had a certain amount of money, if you know you could spend $1,000, could you do one contract here? Right? 1% of 100,000, right? $1,000. And if you got 630 here, could you do one contract? The answer is yes. Could you do two contracts? You could, but are you violating that rule if you follow that rule? Right, Scott?
That's right.
All right, folks. All right, so that's what that slide is talking about when we get into this right here, okay, and your break-even points. So the reason why I have the max here is because let's say the stock goes the direction you want to do, which means it stays above your short put. That means your max gain is your 370. All right, if it goes down through, and we're going to cover this when we get to the exits. If it goes down through both, your max loss is what? 630, right? And that's why you have a what? A line here showing your max loss on this side. All right, you're capped on your gains and your losses. All right, here we go. All right, so yes, this trade pays when the underlying increases. That's right. This is a what? This is a neutral to bullish trade. And why is it a neutral to bullish trade? Scott, why is it a neutral to bullish trade? Why is this trade that way?
Well, because you think about it, we're selling, so we're short that put position. So what do we want to have happen on that short put position? We want it to stay above that unless we want to take possession of it. Again, just to bring that up. But we want it to stay, typically a trader doing that because they want it to stay above that price. Why do we have the long? The long's there to protect us and to give us more or maybe a different look at opportunity. That's all.
There you
So,
go.
yeah.
Cool. All right, so let's look at this example. Oh, here it is, Scott.
Yeah.
ZYX is back.
Yeah. Imagine that. We're gaining some familiarity with that.
All right. So ZYX, all right, is trading at $90 per share. All right.
Yeah.
So here we are. It's trading at 90. You see that, right?
Yep.
All right. Trading at 90. All right. And we're going to do a short put vertical. Remember our hand example. All right. We want this to go up a lot, up a little, sideways. It can even go down a little bit. And we have all four of these in our favor. We just don't want it to go down a lot. Okay. So when it comes in here, we're going to sell an 88 strike put option right there. Okay. We're going to sell the 88. All right. And we're going to get, when we do that, we're going to pull in a premium of $2.25. Okay. And I showed you where that is. Remember, the bid column for that strike price is going to say 225. All right. The bid column on your option chain for that stock and that current expiration under the 88 strike will show 225. That's where it comes from. All right. Then you're going to go and buy, in this case, two strikes in. All right. An $86 strike put. You're going to go long. So you're short the 88 and you're long the 86. And that's going to cost you $1.25. Okay. So your credit you pull in is 225. and then basically saying with that money, it doesn't matter, but then you're going to go buy the 86 strike for $1.25. Okay. That's your spread. So your spread is what? $2. Okay. Spread is $2, right? And your credit is $1, right? 225 minus 125.
Hey, Ray.
Yep.
Can I jump in on you real quick here? I
Yep.
think, that there tends to be some question around this sometimes, and it's been asked a couple of times in the chat. Um, this is a vertical spread. A vertical spread means we're within the same month.
Correct.
We're actually within the same expiration. It's not just same month, but same expiration. So that makes it a vertical spread, meaning that one price is here, and then the next on, if you're looking at it on the options chain, the next one is vertically below it or vertically above it in the opposite examples. Now we're getting questions or comments. Well, what if can I do it in a different month? Can I buy one in this month and sell one in a different month? That is a different type of strategy. We do get into that in some of our more advanced classes, but for those of you who are wondering, that's a diagonal, two different strike prices, two different months. And so it's, instead of being the same strike price, it's different, but then we go over here, so it makes it a diagonal spread rather than a vertical spread. So helping to understand sometimes the nomenclature around this helps to maybe clarify some of the potential confusion too, Raymond.
Perfect. And I'm glad you saw it because and folks, I don't know about you. I mean, maybe y'all have taught with this kind of a scenario before, but when you're teaching and you got chats flying by, it's hard to read all those. So Scott, I'm glad you're able to see those and bring that up as we're teaching, because otherwise I would not see it. So thanks for doing that. All right, here we go. All right, so keep going. So they collected a total premium of $1. All right, you collected a total premium of $1. So here we go. What if, so we did the trade. We got those two options. We got the long and the short. Remember, we're 88 and 86 right there where it says by the gray flags. So what if the stock goes up? Now, this is a short put vertical. Ideally, that is what we want. We want the stock, the underlying stock, to increase in value. You want it to go up. All right. You want it to stay above the short strike. Okay. That's the key. You want it to stay above the short strike. You want it to be, yes, out of the money. All right. You want it to stay out of the money. Okay. So in this case, let's say the stock closes at $91 at expiration. All right. It's up here. It's expiring. It's up here. You sold the 88. All right. You sold the 88. What does that mean? Well, that means both options are going to expire. Okay. Both options are what? Out of the money, right? Your long's out of the money, your short's out of the money. So both were expire worthless, which is a very nice thing. You don't even have to pay the fee, the 65 cents fee per contract on this. All right. Both expire worthless. The profit is capped at 100, remember, because it's what? The two strikes minus the credit. So you got $1. So both the profit is capped at $1 or $100. The credit received minus the transaction cost. All right, that is in there. All right, and there you go. You're done. You're set. You're off going, yes. Okay. Made money. That's the idea. But Scott, this is probably the thing that freaks traders out the most is this scenario right here. What if the stock goes down a little? Okay. In this case, it went down through your short strike, but didn't go down far enough to make your long put in the money. It's still out of the money. Okay. So what happens now? All right. The short put is in the money. Okay. And likely gets assigned. Uh-oh. Just like we talked about in class yesterday. All right. Your short put's assigned. You got to buy the shares. Okay. Your long put, however, all right, is out of the money and expires worthless. So that means you have to do something. Now you're going, oh my gosh, I have to come up with all that money to buy those shares. The answer is yep. All right. And if you don't have that money, typically you're going to get a notification and they're going to say, what do you want to do? Do you want to just sell at the current price on Monday morning? or do you want to add money to your account? You'll have things you can do. All right. So the world's not going to come to an end. All right. But you have to do something. Okay. So in this case, you'll have to buy the stock at 88 and either hold it or sell it back or whatever price the market gives you. Okay. So it's not, but what did you get when you did this? Did you still pull a dollar in? You still pulled the dollar in, right? You still did do that. So that is on that as well. So you're going to hear this in a little bit, and Scott and I will say this to everybody. So Scott, is there a way to alleviate this kind of thing at expiration about expiring or getting out of the trade?
You're leading the witness. I'm not sure I'm picking up what you're putting down, but
Okay.
I
So
think what you're asking me, Ray, is proper management of the trade,
there
right?
you
And
go.
so as I'm getting close to expiration, I got to be paying attention to this. And I need to start making some decisions, what if type of decisions. So those algorithms are already at work in my head. If this, then that, if this happens, then what am I going to do? So I don't get froze when it happens. You've laid out what some of our choices, I was going to use the word options. You've laid out what some of our choices could be here. And they're all viable. Another
Yeah.
one is you can roll, so yeah.
So remember, if this is at expiration, you don't have any choice now. This is
Yeah.
this,
Oh,
this is
at
at expiration. So,
expiration. Yeah.
yep, you're
Yeah.
done. So
You're
that's
done.
why one of the things you hear us say a lot of times is this: exit the trade 4 to 10 days prior to expiration.
Yeah.
All right. And when you do that, what you're doing is you are eliminating the obligation. If you exit the trade 4 to 10 days prior to expiration. Now, why do we say 4 to 10 days? Well, there's a couple of Greeks we talked about on day one that can give you a good reason why to do that. For one thing, what's happening to time decay? Okay, it's decaying really, really quickly. All right, that's helping you. But what about the one that gamma? All right. Gamma is increasing more rapidly as you get close to expiration. And if this is going the wrong way, what's that doing to the value of the option? It's bringing the option the wrong way. So that can hurt you pretty quick. All right. When you get close to expiration, it can hurt you bad. All right. And volatility. What if all of a sudden volatility starts spiking as you get close to expiration because it's going the wrong way? All right. Then that can hurt your value of your option. It can start increasing in value doing the opposite of what you want to do. All right. So you got to weigh that and go, am I okay with taking 80% of the profit as opposed to just letting it wait out to expiration and hope it keeps going the right direction? All right. Eliminate the obligation, get out early. Get out 4 to 10 days early if that suits your trading style. And that can help you with not having this situation go on. Because I can tell you, it's easy to do. Scott can verify this. I was in a workshop one day and I said these very words. I said these words. I can't go any lower. Guess what? It did. All right. And so I came up with the max loss scenario. But look at this. If this is the actual stock, it comes down to 88 and you're getting close to expiration. It bounces back up. You're okay. Then it gets back down again, close to 88. It bounces up. Did you have opportunity to get out when this was still above 88? And the answer is yes, you did. But when you waited and then it continued to go down and you broke through 88, now you're in a situation where you have a loss and you may not want to do that. So Scott was talking about managing that time as you get close is very, very important. And one of the things you might do to help is get out 4 to 10 days prior to expiration. All right. So the short option can be assigned at any time up to expiration, regardless of in the money amount. All right. So just remember that. All right. And can you do these with paper money? Absolutely, can do this with paper money. This is actually a great way to use paper money is to practice a new strategy so you can actually see how these work. All right, Scott, what if the stock goes down a lot? What if it goes through both of your long and short options?
Well, let's pull up those next bullet points here,
Yeah,
Ray,
man.
because yeah, this is a scenario that can happen. If you trade these long enough, it probably will
Yeah,
eventually happen to you.
it happened to me.
So I know it happened to Ray once. It's happened to me more than once as well. In this example, the stock goes clear to 85 at expiration. So the short's in the money. We're going to get assigned, right? But the long is also in the money, automatically exercised. Automatically exercised to do what? To pay the assignment.
Yep. So, so in this case, the short put is what? In the money, gets
Yep.
assigned, right? The long put is in the money, all
Yep.
right? Automatically exercised. So, key words: assigned, exercised, assigned, exercised. All right. Assignment happens when you are obligated to something. You get assigned. Covered
Yep.
call. It's assigned. You have they can take your shares. Short put, you get assigned. You have to buy the shares.
Right.
Exercise is when you buy a call, all right, buy a put, all right. So when you can then exercise that option, which means
You're right.
you have the right. There you go. You have the right to do something. In this case, you have the right to sell them at 86 if you're long the put, all right, and it's in the money. Why is this put in the money? Because the stock's at 85, so
Yeah.
the 86 now is in the money. So these are automatically going to take care of themselves. And this is your max loss scenario. So in our AMD example, our max loss is what? 630 bucks. You're not going to lose the entire huge amount of $42,000 because what? You might get assigned here, but you have the right to sell it there. Okay? Hope that makes sense. So the thing to look for or the thing to remember when it comes to these short vertical spreads is don't let it get so out of control in your mind that it's a difficult thing. Look at each leg individually as what it is. One of them is a short put, one of them is a long put. And you can manage, then you can see and understand and remember what you did on day one to learn okay, how do I manage that? How do I get in? How do I get out? Now, there was an example. Can I show examples of this? Yes, Scott and I are going to show examples of all these things right here. Okay. So your total loss is $100. Distance between the spreads minus the net credit. In this case, it was just a real short distance. But all right, the short option can be assigned at any time up to expiration, regardless of in the money. We keep saying that. Why do you think we keep saying that? Because we don't want it to go all of a sudden you get assigned, you're going, I didn't know I could be assigned. All right. But you can anytime. All right. Example, FAMB is trading at $30 per share. All right, down here, here it is, trading at 30 bucks per share. All right. Now, one thing this should be concerned you about is okay, this is my short. Okay. This is on a downward trend. All right. So in this case, what do you think this might be? Do you think this might be and there's giving away here. Is this going to be a short put or a short call? What do you guys think? If the stock's going down, right? Earlier the stock was trending up. Now the stock's trending down. So should we do a short put vertical or a short call vertical?
All right, Ray, you're getting them to stand on their head now. I mean, that's a switcheroo right there. You're talking about a bullish strategy, and now all of a sudden, you're throwing a curveball at us with this kind of bearish strategy here. What's that all about? What's
That's
going
that's
on?
to see if they're paying attention, and they
Yeah.
are. Look, look,
Uh-huh.
look, look, look. There it comes.
Yeah.
Look,
Oh, everybody's got it. Short call vertical. There
there
you
you
go.
go. All
Yeah.
right. So remember, these do have a bias to them. And what is the bias? Chop, 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 chop. I like that. What is the bias? Look at the name of the trade in this case. All right. All right. A short put. Short puts are what? Bullish. Short calls are bearish, right?
Yeah. Yeah.
All right. So if this is in a downward trend, now we're looking at doing the same type thing, but selling the calls and going long the call, all right, to get the same kind of activity. All right. So short call vertical. So FAMB is trading at $30 per share. All right. You sell the 32 call, all right, for the premium. And someone asked earlier, what is the premium? The premium is the money you're pulling in when you sell that option. So underneath the figure that's underneath the ask column, all right, and the bid column are the numbers of those are the premiums. So in this case, if you're going to sell a call, you're looking under the bid price, and whatever that figure is, that is the premium you're pulling in, that $1.50. All right. And then you're going to do what? You're going to buy the 35 call, few strikes out, okay, for 60 cents. All right, there's a difference of a net credit of what? 90 cents. All right, 90 cents. So how's this going to work? All right, so if you got a $3 spread, all right, and you got a 90-cent credit, all right, you collect the total premium of 90 cents, all right. That's the six, I'm sorry, the 60 from the 150. There's your 90 cents. All right. And that's going to be multiplied by 100, multiplier of 100 because we're doing one contract. All right. So, Scott, we did this. We sold the 32. All right. Let's say the stock closes at 31. All right. It is below that short call. Is this now an out of the money situation?
That's out of the money.
Out of the money. So, is that what we want to happen when we do a short call vertical?
It is. We're going to treat this. So think back, guys, a couple of days ago, think back to your covered call examples. That was a short call. It was covered because we own the stock. This is protected because we're buying the strike above it. But just think of it in the same kind of terms or idea as potentially a covered call. So we want the price of the stock to stay below our strike price. In this case, what's the strike price, Ray? 31? Or 30?
No, the strike, we sold the 32 and it went to 31.
Yeah, 32.
So it went up a little bit, right? Kind of went up a little bit. So, but we're okay as long as it stays below, right?
As long as it stays below 32.
Yeah. And so I got a good question. How do you know how much of a spread to use? All right, so that's a good question. And we'll hit it again later, but let's do it right now. So you got a 32, we went 3 strikes out to 35. So you got a $3 wide spread. All right. And then depending on the amount of money you pulled in this case, we pulled 90-cent credit in. Now, if you went to 37, okay, 37, that's a $5 spread. 1, 2, 3, 4, 5. That'd be a $5 spread. That would be probably a little bit less money. So you might get a little bit more money, all right, on the premium. But now you got a larger risk because you have $5 wide spread. Okay. So this is a you question. Are you okay with that much risk? All right, because now with a $5 spread, and let's say now you're going to subtract, I don't know, maybe $1, that's a $4 wide risk. All right, which means that's what you're going to be liable for if it goes against you at 100% at a max loss. So the wider that spread, the higher amount of trade risk you have, and that's what you got to weigh as an individual trader. Okay, good question.
Right, one more really good question. What happens if the short call expires exactly at 32?
So there's this thing called pin risk. All right. This thing called pin risk. So let's say you're trading and on Friday, the stock goes up, goes up, goes up 32. Are you okay? Yep, you're okay. All right. Now, it might be at 31.98, but then at that, like an hour, I think it's an hour and a half between close and settlement. All right, it might move to 32. All right, you're still okay. But what if it pins at 32.01? Now it's in the money and you may be obligated, you may be assigned. All right. Another reason to understand time management, and you may want to exit the trade when 4 to 10 days prior to expiration. And why do we say that? It takes the obligation away. All right. Takes the obligation away. You don't have to do it. It's up to you. It's just one technique to help protect yourself if that's something that's good for you. Okay.
Ray, may I throw out another technique?
Sure.
So you're saying 4 to 10 days. Some investors also think as soon as I've made 80% of my potential maximum profit or a percentage of their potential maximum profit, then they will also look at closing the trade.
Yeah, very true. There you go. All right. I'm trying to read some of these chats as we go along. We're hitting most of these answers, so it's just pretty good. All right. We're getting open interest in a minute here. All right. So both options, all right, both options in this case, when it expires at 31, are out of the money. Both expire worthless. All right. You capped your profit at 90. All right. And you're good to go. You're done. Now, what if the stock goes up a bit more? And let's say it goes to 33. So now you're in between the strikes. You're in between the strikes. Okay. So in this case, the short call is in the money and gets assigned, which means you must deliver the shares. All right. But your long is out of the money and expires worthless. You don't have the protection now. All right, because you're at expiration. You don't have that protection. So you got to do something. All right. You'll have to sell the stock at 32 if assigned. All right. So if that's the case, are you going to lose some money? Yeah, you're going to lose some money. It went against you. All right. But the world's not going to come to an end. All right. So just understand that as you're making your trades and figuring out what is your risks. Okay. The short option can be assigned at when? Any time up to expiration, regardless of the in the money amount. We're going to keep saying that to you till we're blue in the face because that is the case. All right. Scott Durfee, what if the stock goes up a lot? All right. Going totally against you and it goes through both strikes. All right. What do we got, Scott?
Yeah, same thing as the last one, only the opposite, right? So the short call's in the money, gets assigned, the long call's in the money, automatic exercise. Just think about the conversation we had 3 or 4 minutes ago around puts.
Yep.
Exact same, just flip it upside down.
Yep. Because both options are now in the money.
Yeah.
So both have intrinsic value. So this is where we get that $3 spread, right? 1, 2, 3. That's your spread of your trade. All right, minus the what? Net credit 90. So your loss per spread is 210. Your max loss. You're gonna lose $210. That's just one contract, obviously. All right. So if it's two contracts, that's doubled. And so on and so on. Okay. So your total loss 210. This is between the spread minus the credit. Short options can be what, folks? Assigned when? Anytime up to expiration. Okay, so some common pitfalls of short put verticals. All right, short put verticals. All right, so Scott, what's that first one?
Traders may fail to understand this, and I love this one. We spent some time actually talking about this last night too. But we may fail to understand that the risk of expiration with the stock price between the strikes. Sorry, that was not the one I was thinking of. But that's one of the things that we forget to manage. And that question has been asked, and it'll be asked again. What happens if it goes between those strikes? We got to be careful. We got to manage those things. So that can be one of the pitfalls, not managing it properly in that direction.
Yep. So a question came up: Are all these taxable? When you do these, they go, yes, folks. It's like any trade you do in your account is taxable, in a margin account. Okay. So next one,
traders. That second one too, Ray. That the second one there. Traders may fail to understand how price volatility may impact trade success. Again, the volatility and the implied volatility, but also the volatility of the stock itself.
Yeah.
And then finally, traders may fail to understand the impact of implied volatility as it relates to option premium and probability. And that's the one that we spent so much time, not so much time, but we spent a fair amount of time on that last night because the application is the same. Remember, high volatility tends to increase the price of options. Is that favorable for us when we're selling options? It is. Is it favorable for us when we're buying options? Not necessarily. So we got to look for that balance in a strategy like this one.
Right. So what do you want when you sell an option? You want it to get cheaper, right?
Yeah.
So you like volatility.
Oh, yeah. Think about it. I buy it. I want to sell it back. So I buy it. I sell it. People give me money. And I want to be able to buy it back as cheaply as I can with the money that I have that they gave me, right?
Right.
Okay.
Cool. All right. So I got a question. A margin that confused you. I never borrow money to place trades in my traditional IRA. Well, folks, in a traditional IRA, you cannot borrow on margin because it's not allowed. On a margin account, just a cash account. Okay. All right, here we go.
Please take those kinds of conversations to your branch people. Those guys are qualified and have more insight and detail around that kind of stuff. So please reach out to those guys.
So I like this comment. Is that a Kleenex to wipe the tears? All right. Yeah. If it's going against you, you don't follow the rules and these pitfalls smack you. All right. Pitfalls of a short call vertical. Look, they look pretty much the same, don't they? All right. Yeah. Traders may fail to understand the risk of expiration with stock price between the strikes. We just talked about that. Okay. All right. Traders may fail to understand the price volatility may impact trade success. All right. Just like Scott says, that stock price, it could be nicely below, and then some news pops or whatever may happen. That strike pops up through, and goes in between or goes through both strikes, wham. All right. You a really quick max loss or a max gain to a max loss in a matter of minutes. All right. Depending on what happens if you wait too long. Don't put yourself in that situation. Manage your time. If it means to give up a little bit to get out 4 to 10 days, you may want to consider that. Okay. And then traders may fail to recognize the bearish bias of this spread. Remember, a lot of times people get confused. Scott did a great job of explaining call up, put down, call up, put down. All right. Call options increase in value when the stock price goes up. Put options increase in value when the stock price goes down. Now you got to put in that extra layer. Okay. Are you a buyer or seller of the option? Okay. And remember, when you're short calls, that is bearish. When you're short puts, that is bullish. Okay. So don't get that confused. There's some things you got to memorize, and those are a few of those things. Okay. All right. Whew, everybody take a breath. Take a breath, take a breath, take a breath. All right. On the screen up there, you got a walkthrough, as they call it, or a 45-minute conversation you can have with our experts out there when it comes to the Think or Swim platform. All right, the thing we've been using all week. All right, the desktop platform. They also can help you on with the web-based version and the app. So don't be afraid to use that. Take a shot of that right there, or use the Bitly link, and you can see where it schedules your own personal walkthrough, if you will. Again, a hint to help you when you do this, and that is to have your questions written down before you start to call. All right, so you can move through a little more rapidly. Okay, and that way you're maximizing your time with these folks because they're awesome and they can help you a ton. Okay, all right. So I got a note here says, can we repeat a few of my last sentences we did? Better than that, we're going to actually do live examples. Okay, so hang tight. All right, here we go. Also, reminder of the upcoming events. Again, if you go to the schwab.com/coaching, and then you go to live events, you can see all these in here and you can register for them. All right, we got technical analysis and options, Chicago coming up in July. Scott and myself and Ben will all be there. All right, doing this live in person is free. Market Drive is a one-day event. It's going to be at the Gaylord Texan here in Grapevine, Texas. I say here because I am like 10 miles from this place. All right, and it's a one-day event, larger scope of what's going on in the market. Again, free. A lot of great things, activities in that. And then we're going to be over in Orlando in August, but we'll be indoors. Great property. So don't worry about the heat. All right, you'll be fine. Come out and see us if you're in those areas if you can. And I think you'll really much enjoy coming to see us all. All right, here we go. I got a sip of water. Okay, here we go. Now we're going to get into the nitty gritty. We're going to start making some trades and we're going to put what we learned into practice. Okay, we're going to put what we learned into practice. Here it is. Sample entry considerations for put spreads. Put spreads. All right, expiration selection 20 to 50 days out. And why again is that? We're going to balance that time decay with premium. Remember the drawing we made earlier. All right, if you go this, okay, and we got our time, okay, and we got this is expiration. All right, this is the fire. Okay, that's the big E. All right, we want to be doing our trades out here when it comes to our time to get in of our spreads. And the reason for that is time is decaying more rapidly. Whereas if you come out here, you may not see the loss of value as quickly as you do here. All right, so again, remember that we did on day one when we talked about theta decay. All right, it'll help you a ton. Okay, now then. So 20 to 50 days out expiration for time decay premium. All right, strike selection, short strike. All right, lower deltas can potentially increase probability of success. Remember we said this earlier. Delta is a proxy for the probability of that option expiring in the money. So if you have a 30 delta, that's a 70% probability of expiring out of the money. Okay, so that's why we say this may increase your probability of success with lower deltas. Scott, do they have to pick low deltas?
No, they can pick whatever delta they want, but
Yep.
based on the what we're teaching here tonight, for all those considerations, that's just a guideline there.
There you go. All right, long strike. All right, so your short strike is there. Okay, your long strike below, this is a put option. All right, below but close to the strike to potentially balance risk and return. So we had a good question earlier about that. You know, you want to go 2 strikes out. Can you go more? You can go further out. You'll see you'll pull more premium, but that also can do what? Okay. Is getting thanks. Ray's getting better at drawing the theta decay. I appreciate that. All right. So the further the spread you make and your long and short strikes, that increases that risk in return. Okay. So just remember that as you get going with your examples you're going to trade. So when you're practicing on your paper money, do some ones that are further apart. Do some ones that are closer. See the difference in how that works for you. Okay. All right. Oop, wrong way. All right. So that's put spreads. All right. Here we go. Call spreads. Call spreads. All right, same thing. Look, 20 to 50 days out, same thing because of our what? Time decay. All right, the closer you get to expiration, time decay increases more rapidly. So you're losing value faster the closer you get to expiration. That's the idea behind a shorter time frame of selling. Okay. Went the wrong way. Sorry. All right, strike selection. Again, lower deltas, potentially increased probability of success because what, again, it's the inverse. Remember, probability of expiring in the money is what delta shows. So the inverse of that is expiring out of the money. All right, long strike again. The closer the strike may balance risk and return. All right, if you go further out, the more you widen the spread, you increase the risk. Okay, because you're obligated for that difference. Okay. So sample exit considerations for put spreads. When you get near expiration, both options are out of the money, considering just let it go. All right, as long as it's under a nickel, you're good to go. You don't pay anything. Otherwise, you got to start paying for what you're going to get out. All right. On
Ray,
the last trade,
when you say let it go, let's be clear. You mean close it.
yeah.
Yeah.
All right. On the last trading day before expiration, okay, if only the short strike is in the money, in other words, it went against you, consider buying back the short strike. Okay. Consider letting the long strike expire worthless. All right. There's no need to pay money to get out of the long strike if it's out of the money. That's what this is saying. Okay. All right. Now then, if both strikes are in the money, in other words, it went through both your short and your long strike, it went against you and went through both of the ones you sold and one you bought, considering let the trade go, you'll get automatically assigned and exercised. It's max loss, but it's done. All right. Commissions and exercise and assignment fees will impact potential returns. Okay. We're going to show you how to close. All right. Call spread. Same thing. Near expiration, let them both expire out of the money. All right. Consider closing or rolling the position when the bid price of the short call is near nickel or less. No change. Everything's exactly the same as it is for the put. All right. Just it's a call or a put. All right. On the last trading day before expiration, if the short option is in the money, close the short side. Considering let the long run, it's out of the money, it's worthless. All right. If both strikes, remember it went all the way up. All right. Didn't go down. It went up and went through both. Considering let the trade go, assignment exercise will automatic. And remember that you have to pay for commissions, assignment fees, impact returns. Okay. And then bottom here, there's no guarantee on a secondary liquid market of any option at any given time. All right. Now then, let's go live. Here we go. All right. So now let's go back and look at that AMD trade that we did first thing before we get started. Okay. So Scott, now it makes a little more sense to people. All right. Let's go look at the chart real quick. Bullish chart. So if it's a bullish chart, are we looking at a short put or a short vertical? Scott Durfee?
Oh, you're asking me a short put. If it's
Short
bullish,
put, there it is.
Short put, yeah.
All right. So we go back to our trade tab. All right. And then we looked at our 36 days to expiration.
Days out.
We looked over here under our delta column. Now, if you didn't learn how to change your columns up, All right, we go over here to our option chain and look at our layout. All right, and we're going to open it up, and you can see where you can change it. You can customize it or use the pre-built ones. All right, in this case, we have Delta, Gamma, Theta, Vega. Okay, and then we go here and we said, okay, what was our range of deltas between 30 and 40, correct? So the 450 strike was a 31 delta. All right. So if I go here to sell, all right, and I hold my control key down, all right, and left click on the bid price under 450, that's the premium I'm going to pull in right there. Boom. All right. And there it is. Sell one, 17 July, 450 strike, 25.25. Okay. Then if I go up here to the, if I can drop this down by hitting this arrow right here. Okay. Then I go over here. Now it's just one leg. Now I have to go one strike out, right? At least one strike out. I can go $20. I can go $30. In this case, it's they're $10 wide. So I go to the 440. I'm going to go to now to the ask column because I have to go long. All right. Make it vertical. I'm going to hold the control key down. I'm going to click on the ask price, and it automatically loads it in to my trade ticket. And you can see it says it's a vertical spread. So I'm selling the 450 and I got a +1 and I'm buying the 440. I'm going to pull in $3.70 credit. So if I know that 370 credit, do I know my max potential loss? Well, it's $10 wide spread minus 370, just like our example we did. All right, so we have a $6.30 potential loss here, right? So if we did this, let's say we did instead of a $10 wide, okay, let's go in here and change this. Instead of buying the 440, what if we buy the 430, okay? Now we get a 685 credit, and you're going, yeah, look at that. We got more money. But what is our spread? $20. So did we just increase our risk, our trade risk? The answer is yes, we did. Because now you take 20 minus 685, and that's your trade risk. All right, so it's up to you now to decide what you want to do going forward, all right, with the kind of trades you want to make. Let's go back to the 440, $10 wide, 370 credit. We confirm and send. And now we see that, okay, I have our max profit 370, my max loss 630. If I have $1,000 to trade, if I did $100,000 at 1%, can I make this trade? The answer is yes, we can. So let's hit send. And now we have it pulled up. Can't make the trade, market's closed. All right, let's do another one. All right, we're doing short puts right now. Short puts. All right, so let's go up here. Let's change to this company called FSLR. Now, are any of these recommendations? The answer is no. All right. FSLR. Now, I'm going to go over here. I'm going to look at the charts tab. All right. Can any of y'all tell me, is this more of a bullish or is this a bearish looking stock? Scott Durfee.
I can't help it. I can't help myself. Drawing a level of support at about seriously, right there. I
All
can't.
right. So let me go to my
this is like when my wife walks in the bedroom and the bed's unmade. You know, you get a little what's that? OCD about something. When I see a level of support like that, I need you to draw that in. So
look at this, folks. So look at this. Bam, 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 bam. Resistance big time. Yes. Broke it.
Yep.
And it broke through. Came back down and bounced right off. And what is this called right here? What is this phenomenon in technical analysis called right there?
That is called a K-hold, a K-hold. You know what I really like about this as well, if you don't mind me continuing my commentary?
That's why you're on this call there, young man. That's why you're here.
Look at that implied volatility, brother.
Well, I'm glad you brought that up.
Yeah.
Look at that right there, folks. Look what that implied volatility is on this graph. If you just looked in the middle, that's probably the average range. Is it above its usual range? The answer would be yes, it is.
I'm following. What would that potentially tell me? That would potentially tell me that premiums are high on that particular stock. So
you got a bounce happening. You got a hold, got a bounce off support, a hold, high implied volatility. So let's go to our trade tab. All right, so we'll be on the call side or the put side.
Put side.
Put side over
Not a
here.
recommendation too, guys. I don't mean to
No,
oversell that, but yeah,
nope.
put
All
side.
right. And then so we're going down here and we're going, okay, what would be an example of between 30 and 40? So we have 240 strike, 250, 260, 270. You got 26, 31, 38, 44. So if you're a little more conservative, you probably pick in this range. If you're a little more aggressive, you might pick in this range. Would you say so, Scott?
Yeah, and look at the premiums. You know that's going to help you with your decision.
Well, I got
Uh,
an idea too. I got an
yeah,
idea also.
yeah.
Let's see if this is actively traded. So
Okay.
watch this, folks. So look at this 250 mark, the 31 delta. 250 to 31 delta. I'm going to go up here and change my outlook to volume and open interest. All right. So
Yeah.
volume and open interest. Volume is amount of options traded, and open interest is open unexercised uh, options. All right. Put. So is that fairly good? I would say yes. All right. Looking like we're not the big fish in the we're the little fish in the big pond, which is a good thing. All right. And so we come over here. Let's go back. Delta Gamma Theta Vega, 31. So if we're going to do this trade, let's sell the 250. So I'm going to click on the 250, pull in $13.50. Okay. Then I'm going to go over here to make it a vertical. I'm going to buy one strike out. We'll go $10 wide. I'm going to hold down the control key. I'm going to click on the buy. All right. So now we have a $10 wide and a 325 credit. So if we have a 325 credit on a $10 wide spread, what is our max loss?
$6.75.
675. So if you're not good like math and like Scott is, all you have to do is get confirm and send, and you go, oh yeah, look, there it is, 675. So if you have a $100,000 account, you're doing risk 1%. Can you make this trade? Yeah. Could you do two of them? You could.
With
If you're
enough
following that rule,
conviction.
if you're following that rule, right? Okay.
Yeah.
So you go in here, you go in account, make one vertical FSLR. All right. It's going to be we know it's 36 days out. All right. Because we saw it on their options chain. All right. 325 limit to open. All right. And it says to open to open. Why is it saying to open to open? Because it's opening both the long and the short call. Okay. I'm sorry, put. And so we're good to go here. So we say, yeah, I want to do that. Should I do it, Scotty?
Yeah, go ahead. It's your money.
Done. All right. Now look at this. When you do this, you go over here and there it shows up right there on your side right there. All right. Let's do one more, then we'll do some calls. All right.
So wait, that this shows up. That's just showing that that option order is open. Soon as it gets filled, it won't be showing up there.
I think it will.
Only if you have that turned on.
Yeah. Yeah. All right. So FedEx. All right. Here we go. Let's go to the chart. What do you guys think? Is it an uptrend? Is it an uptrend?
Uptrending.
Uptrending.
Hopefully
You got
uptrending.
you got what is this right here? Big old what?
Another hold, and that's a bounce off of support. It's the same as this. It's the same as the other one. It's just not as pronounced, right?
Right. Right.
Yeah.
So it's near all-time high. So we should not trade it, right? Because it's at
Oh,
all-time high.
yeah. All-time high bailout.
Okay.
Just
Now we do have this coming up. Earnings. Now I'm doing this on purpose because I'm going to show you the earnings coming up. This may sway you from getting into this trade. All right. Because when earnings come up, can remember the pitfall? Price volatility can what? Severely impact your trade. So I'm doing this. So maybe you're placing it in a paper money account with you. All right. And so if you see this and you can see what happens to the price action to a vertical spread when option when earnings come out, and it may go against you. All right. So maybe practice this in your paper money account so you can see what happens when this comes out and pops, and it might go in the opposite direction. Okay. But volatility is increasing right now because it's coming into earnings. So this is a good example trade for your paper money account. All right. So we go in here. Let's go to the trade tab. All right. We're on the put side. And then we go, okay, there's a 32 delta right there, the 320. All right. So let's go in and let's click on the 320. Then we're going to close this down. and we're going to go over here to the 310, hold the control key down on your keyboard and click the buy, the long. So now we got a $10 wide spread, a 352 credit. That means we're going to get we got a max profit of 352, max loss 648. Send it. All right. Those are short put spreads. Now, let's go over here and let's look at some of these. ADBE. All right. ADBE. Let's look at the chart. Tell me, is that uptrending or downtrending? Downtrending, yes. So we got a downtrending stock. All right. So if we have a downtrending stock, not only is that Scott Durfee, I know you're going to like this. All right.
I do. Yeah.
We got right there.
You have a break in support there, a kablode.
All right. Breaking support. All right. And
Wide volatility is up on this one too, buddy.
yeah. So let's go up on this high volatility because what happened here? Earnings. All right. So if you go to the trade tab, all right, we go in and we say, okay, are we on the put side or the call side?
We're calling now.
Oh, short call vertical. All right. So we're going to go out of the money. All right. And we have here is where are we at?
215.
215, I think it was. I wrote the wrong number down on this thing.
Yeah, you did. Yeah,
All
we
right.
should be 215.
Yeah. So, well, no, it's okay. We can do a 240, 30 delta. All right. So we go over here and we're going to do what? We're going to click on the bid price. We're going to sell. I got to open this up a little bit more. Let's go 20. All right. We're going to do 20 strikes. Okay.
So it's what you just did there, Ray. That's kind of a nice little thing to know. What did you just do?
Oh, so all I did up here on the strikes is I just increased this number up here. You can do a drop down, but I don't want to do all because it's too many. And you can just customize how many strikes you're going to see. So I typed in 20. All right, and enter. So I got 20 strikes. All right, so here's the 30 delta. All right, 30 delta right there. All right, if I go across here and I look at the bid size, all right, I'm going to click on the bid. Okay. So I'm gonna pull in 675, but I'm making a spread trade out of this. So I gotta close this back down.
You
Now,
said
one
675.
strike out, which means you got to go lower down. Okay. What did I say?
You said 675 at 765.
Oh, no, well, there you go. It's
I
that.
just fucked it, friend.
Thank you. And then I'm gonna hold my control key down, and I'm gonna go down a $5 wide spread. All right. And I'm gonna get by there. So I have a $1.20 credit, a $5 wide spread. So if we do 5 minus a $1.20, all right, pull in 120, and you got a $380 max loss if it goes the wrong direction. Okay. So if that's the case, and I like my trade, I'm gonna hit what? Send. All right. Let's do another one. Is this helping, folks? Hopefully this is helping you. All right, let's do ICE. All right, ICE. All right. Tell me, is that bullish or bearish? Looks a little bit what?
We're a little bearish. We're in a
Bearish to me. All right. You can go up here and we could say, there's several levels of actually the moving average is acting as a level of resistance now. Okay. But if we go up through here, where it just recently broke and this tail right here, if we draw in, all right, right in that range, right about in there, level of what? Resistance. Okay. So I've got the implied volatility is high, kind of rolling down. All right. MACD still in the red. Let's go to our trade tab. All right. We're going out 36 days out again, looking for a 30 delta. Here's 33 delta, 145 strike. All right. So I'm going to go sell 145, close that down. Then I'm going to go one strike out. Okay. I'm going to go control key. All right. 125 credit. I'm pulling in a $5 wide spread, 375 max loss, confirm and send. And there it is. 125 max profit, 375 max loss.
Ray, you're risking 375 to make 125 on this one.
That is correct. All right. Send. Okay. So we're looking, are you getting the feel for it?
Yeah,
All right.
right now. So go back to the chart, will you? Just real quick for me. So, gang, what we need to have happen now is we need to have what we just sold a 145 call, right? Right. So we need the stock price to stay below that 145 between now and expiration.
Yep.
And as long as that happens, then we hit that maximum profit. So I just want to make sure that we have in our mind now, we're at the call side, so we just need it to stay below that 145.
Yeah. And that's the whole premise of this thing is you have that hand again. So in this case, if it goes down a lot, it just gets the options get what? Cheaper and cheaper faster. You're
Yeah,
short, right? If it
yeah.
goes down a little bit, you're good as long as it stays below what? 145. It can go sideways. Matter of fact, folks, this stock's trading at 138.98. Okay. It can go sideways. All right. And you're gonna get max gain at expiration. Because what's gonna happen? What do you have? Theta decay, right? It can actually go up, right? It can go up to what? One, actually higher than 140. It can go to 165.25, right? Because just what? You got your credit. Now you got your credit in there. Is that works for your break even point. All right. So right now it's at 138. It can actually go up, all right, several dollars for you, and you still make max gain. All right. So long as it stays below 145 for max gain. All right. Let's look at this one. Let's look at one more. Let's look at one more. We got time. Here we go. NFLX. I do want to show them how to get out of a trade, and we'll get one more after that. So Netflix, what's it doing?
Downtrend.
Downtrend. All
That
right.
10-day moving average has a level of resistance. Implied volatility is up, which is favorable if we're going to sell an option.
Yep.
So there you go.
Doing the level of support and resistance. We're asking people asking, how did I draw all that stuff in? Well, I look at where the stock was trading off, bouncing off of. And then when you draw a trend line or a price level, you just click it once, start it, click it again, then it'll draw it in. All right. What's implied volatility doing?
It's rising
Yep. So it's way up here. Yes.
way up there.
It's top.
It's
All
gonna
right.
pull back.
Let's
Yeah.
go to our trade tab. All right. Matter of fact, you can scroll down here to your stats and neglect the pride volatility. All right, here we go. 48, it's in the current IV percentile, 89th percent, so it's pretty high right now. Yeah. All right. So let's go and see what we got. 36 days out, call side. We look at our delta. Let's find, we've got a 25 delta right here. All right. So we could sell the 90. All right. We sell the 90. And then we're going to buy the 95. Okay, control key. All right, a 67-cent credit on a $5 wide, so not as much here. All right, so when you come in this, now you're going to say, well, I'm making 67 on a 433. That may be too light. That may be a little bit too wide, or that may be too much risk. You may not want to do that. It's up to you. All right, but let's do it anyway. All right, here we go. Now then, if you go to our monitor tab, now some of you guys were asking earlier. Oh, I'm here. All right. How do you get out of a vertical spread? All right. So here's a vertical spread right here, TJX. All right. And I got it in my monitor tab. I'm up. I'm making some money right now. I just put it in a little while ago. I can open up the little caret and you can see that I have a 17 July 150 put spread. All right. So I'm short the 155 and I'm long the 150. All right. I'm short the 155. I'm long the 150. So if I go here and do TJX, let's look at it. TJX. All right. Now, am I looking pretty good? If a short put spread, is it going the right direction, folks? Yes, it's going the right direction. All right. So I'm liking that setup. All right. But let's say I want to go in and I want to get out of it right now. I made some money. If I want to get out of that trade right now, all you have to do, all right, you don't even have to open it up. You can just right click on the order and create a closing order. And you go right there to buy vertical. You buy the whole vertical, buy it out, and you made your money. Okay. Or you could close one side if you wanted to. All right. If you think that you're getting close to expiration, which we're not, and you want to just close out the long or the short side, Could you buy back the short? The answer is yes, you can. And that's how you do it right there. Okay. Could you create a rolling order? All right. If you go down here, you can see where it says right here, create rolling order. So if you go in here and you say, I want to do you can do the roll the whole vertical and it shows you the strikes that's in here. So if you click on that, it's going to pull the trade up. Here's the current one on the bottom, 17 July. I sold the 155. I'm sorry. I'm going to buy back the 155 and sell the 150. And then I'm going to go further out in time, one more week. Okay. And it's going to say, okay, do the same prices, sell the 155, buy the 150. But look, it's not going to give me a credit though. So in these cases, if you're going to roll a credit spread out, roll for credit or forget it, or change the prices, okay? Change the strikes. So maybe I want to make a new one and I can say, okay, instead of 155, maybe I want to go 160 and then make this the 155. All right. And now I got a credit because I just went further out in time and I moved the trade up. Make sense? I went out in time and moved the trade up. Okay. And that way I increase my credit still and I have more time. All right. If you want to do that, you can confirm and send, hit send, and now it just rolled. Okay. That's how you do it. And you can see it shows up right here that you had that in place. Okay. So I think that's all I wanted to show on those examples. Let's do one more. Hey, Scott, let's do one more real quick. I think we have time. All right. Let's pull up this one. Let's pull up JPM. So on this one, Scott, here's JP Morgan. All right. It's kind of going sideways. Yes. You're on mute, Scott. You're on mute.
So sorry, drawing that support and resistance, Ray. They're pretty, pretty
So
clear.
you got one down here.
Yep.
All right. And you got one up here.
Yeah.
All right. In that range. So it's kind of going in between. Yes.
Yeah.
So it's kind of curving up right now. You got a kind of a bullish flag right there. Yeah.
Yeah.
All right. So, and you got a resistance level up here. Let's do the call. Let's say it's not going to get above this intermediate term resistance level.
So are you going to do a call or a put
Short
spread?
call. Let's do a short call one right there. So we go over here. All right. Remember, I got it linked. So JPM, and we do let's do the 29, right? It's about 30, right? So 29 delta. So if I sell this one, all right, and then I buy this one, all right, whoop, I went the wrong way. Do not do that. I clicked the wrong one. Sorry. I'm going to sell and then buy the right direction, not a long vertical, doing short verticals. All right, there we go. There's a vertical right there. Get a 110 credit.
Hit confirm and send.
All right.
So we have, we're making 110. That's our max prof. Our max loss is 390.
Right. So
Remember that.
Remember that number. All right, here we go. Then, so Scott, you maybe draw in both sides.
Yep.
So I got down here also.
Let's do a short
call coming this way. What about this? Should we forget about this bottom section here?
No, we can take advantage of potentially that as well, Ray.
All right. So if we go into the put side now, keep the trade live, and we go to the put side and do a put vertical. All right. Let's do the 300. They could sell the 300 and then buy the 295. Okay. Now we got this, we have 4 legs on this, and we're going a short call vertical on the top, a short put vertical on the bottom, and we hit confirm and send. Oh, look, our profit went up and our loss went down.
Our potential loss went down. Yeah. Kind of an interesting trade, Ray. This is called an iron condor. Many of you already guessed that, and you put that in there. And this is one of the strategies that we talk about in some of our other more advanced classes. You're going to find a ton of this available in the Trader Talks right here on YouTube as well.
And as long as it stays below 330, which is right there, and above 295, stays in between, we get that max profit. Iron Condor, folks.
5 to 330. That's a $35 range.
There you go. So, hope you guys learned a few things. We did all of our short puts and short calls, and we even ended it with a little bit of a bang with this thing called an Iron Condor. And yes, this has been recorded. All right. And so, if you enjoyed this class and you learned maybe one or two things, please go to that survey. Let us know how you did and how we did, and give us your feedback. You guys have been doing a great job with that all week long, and we greatly appreciate you. Hopefully now short verticals don't scare you as much. All right. It's not that complicated once you start practicing it and working it in. I think you'll be more comfortable with time. The more you do them, the more you're going to get out of them. Scott Durfee, what say you, my friend?
Hey, gang, don't forget tomorrow morning to join us for the question and answer. We have millions, it feels like, of just wonderful questions that have come from you all. We've been able to begin to kind of collate those and put them in. So we're going to have a great experience tomorrow with that Q&A. Don't forget to join us.
Yeah, we have a lot of questions that were pre-submitted. Scott and I went through and we collated them best we could, and we're going to try to put them together to give you a kind of a recap of what we did this week. So thank you for all those questions. With that, thanks to Scott Thompson. You're amazing, Scott. Thank you for everything. Again, there's that link.
Buddy, show us that last slide. There you go.
Yep. And remember, options contain risk, folks, and not suited for all investors. And make sure you understand before you get in those trades all those different nuances. All right. Again, thanks very much. And tomorrow morning we'll see you. I think it's 10:30 Eastern, 9:30 Central, and down the line it goes. And look forward to a great hour with you for your Q&A session. Scott Durfee, send us away, please, sir.
Yeah, have a great night, everybody. We'll see you tomorrow morning.
All right, man. Good night.
See you guys.